Advanced Audit and Assurance, Chapter 2, The Regulatory Environment. Content 1. The need for regulation of audit and assurance services. 2. Professional standards. 3. Corporate governance. 4. Money laundering. 5. Consideration of laws and regulations in an audit of financial statements, ISA 250. 6. Chapter Review. The need for regulation of audit and assurance services. The section overview are 1. The public interest. 2. The ethical regulation. 3. The legal regulation. 4. Professional regulation. 5. Harmonization of the accountancy and auditing profession. 1. The public interest. The key reason why audit and assurance services should be regulated is to serve the public interest. Assurance providers give an impartial, professional view on issues that matter to users of financial and other information. It is important that this view can be trusted. Therefore, assurance providers need to operate 1. Within ethical boundaries. 2. To consistent standards. You know from your previous studies that assurance providers are regulated by 1. The law of the land in which they operate. 2. The ethical standards of the land and the professional body to which they belong. 3. The professional standards adopted by their country, for example, the International Standards on Auditing, ISA, and Nigerian Standards on Auditing, NSAs. Ethical regulation. Assurance providers are given ethical guidance by 1. Professional bodies, for example, the Institute of Chartered Accountants of Nigeria, ICAN. 2. Law. 3. International Federation of Accountants, IFAC. You should already be familiar with most of the ethical guidance relevant to this syllabus from your earlier studies, which is revised in Chapter 3. Legal regulation. Most countries have legal requirements associated with some assurance providers, particularly auditors. Examples of these legal requirements in Nigeria can be found, for example, in the ICAN Act of 1965, Companies and Allied Matters Act 2004, Bank and Other Financial Institution Act 1991, and Insurance Act 2003. Professional regulation. Auditors are required to carry out audits according to professional standards, that is, ISAs and NSAs in Nigeria. Some assurance work is also covered by professional standards, although this is a developing area and less guidance is available. In many cases, guidance given in auditing standards can be adapted for use in assurance services when there is no specific guidance for that service. As assurance provision goes increasingly global, the harmonization of such professional guidance has become necessary. Harmonization of the accountancy and auditing profession. The International Federation of Accountants, IFAC, is an international regulatory body for the profession, but each country has its own regulatory regime for auditing, which may not necessarily apply the same principles of audit behavior as those used by the IFAC. The same arguments that have been made in favor of the universal adoption of the international accounting standards can also be made in respect of other regulatory aspects of the auditing and accounting profession. 1. These include advantages such as the adoption of global auditing standards, which should improve the efficiency of the audit process for multinational companies and should improve transparency in audit reporting. Disadvantages include the the problem of getting international agreement on auditing practices and the need for many countries to change their local law to bring it in line with the agreed international practice. A number of initiatives are taking place to harmonize the regulation of the auditing profession internationally. These include the following. 1. Audit of all listed companies in the European Union should now be carried out in accordance with international standards on auditing. 2. Moves to establish a more formal statute-based corporate governance regime such as Sarbanes-Oxley in the USA. I repeat, moves to establish a more formal statute-based corporate governance regime such as Sarbanes-Oxley in the USA. 3. The development of the national regulatory models for the profession, headed by a single unified body. The Financial Reporting Council of Nigeria is envisaged to play this unifying role in Nigeria. The Securities and Exchange Commission (SEC) in the USA is a long-established example of a unified body. In the UK, the Financial Reporting Council (FRC) also has a unified role and 1. Set accounting standards. 2. Set auditing standards. 3. Enforces and monitors compliance with those standards. 4. Oversees the self-regulatory professional bodies such as ACCA, the ICAEW, and ICAN. It has been suggested that stricter regulation from an external authority such as the SEC in the USA and the FRC in the UK is needed to balance the increasing global power of the Big Four professional accountancy firms. Professional standards. Section overview are the international standard setting process, Nigerian standards on auditing (NSAs). 3. Preface to international standards on quality control, auditing, review, order assurance, and related services. The IAASB's Clarity Project. ISA 200, overall objective of the independent auditor and the conduct of an audit in accordance with international standards on auditing. 1. The international standard setting process. International standards on auditing, that is ISAs, are set by the International Audit and Assurance Standard Board, IAASB, which is a part of IFAC. A subcommittee of the IAASB is asked to write an exposure draft of the new standard which IAASB considers that one is required. This draft is then exposed to interested parties who comment on the exposure draft. Interested parties include national standard setters such as the Auditing Practice Board in the UK and the professional bodies such as ICAN. The comments are reviewed within the IAASB and the draft is amended as required. Finally, a new ISA will be issued. 2. Nigerian Standards on Auditing (NSAs). The Nigerian FRC, that is the Financial Reporting Council, has overall responsibility for setting auditing standards in Nigeria. The FRC works closely with institutions such as ICAN in developing these localized auditing standards. Nigerian Standards on Auditing (NSAs) are based on the ISAs issued by the IAASB. Minor changes are made to reflect local terminology and legislation. However, the underlying substance of how to audit and the approach to a risk-based audit remains the same in both of ISAs and NSAs. International standards are drafted to be used internationally and promote consistency in audit and assurance practice. However, Situations may arise where the requirements of the international standard clash with national standards. In this situation, there are a number of matters that should be considered. 1. ISAs are not designed to overrule national requirements, so auditors should follow national requirements. 2. However, as ISAs represent international best practice, countries are encouraged by the IFAC to change their national practice so that ISAs can be followed. 3. If there is no comparable guidance to the ISA in the country, then individual ISA practice can be adopted immediately. Illustration: Nigerian Standards on Auditing. The Institute of Chartered Accountants of Nigeria, as a member of the International Federation of Accountants, is committed to the Federation's broad mission of the worldwide development and enhancement of an accountancy profession with harmonized standards, able to provide services of consistent high quality in the public interest. As a condition of its membership, the Institute of Chartered Accountants of Nigeria is obliged to support the work of IFAC by informing its members of pronouncements developed by IFAC and by using its best endeavors to work towards implementation. When and to the extent possible under local circumstances of those pronouncements, and specifically to incorporate the principles on which they are based. An ICAN committee will review standards issued by IFAC and, following a process of drafting, redrafting, and review, will subsequently issue the IFAC standard in its amended and localized form as a NSA. To reflect the fact that the most consistently referred to and commonly used audit standards across the world are the ISAs, this study text and your exam will refer to ISAs throughout. You just need to be aware that NSAs exist and how they map to ISAs. The table has been provided in the preliminaries to this study text that shows the mapping between IFAC standards, ISAs, and ISQC 1, and Nigerian standards, NSAs and NSQC1, where equivalent Nigerian standards exist. Note that not all the ISAs have been localized into NSAs. Hence, why the Nigerian standard list is shorter than the IFA standards list in the examinable documents table, also provided in the preliminary section. Preface to International Standards on Quality Control, Auditing, Review, and other assurance and related services. The IAASB issues a number of other international standards in addition to ISAs. The table below sets out these standards, including ISAs, and when the preface says they are to be applied. Type of standard and when they should be applied. Number 1 type of standard is International Standards on Auditing, ISAs, and it should be applied in the audit of historical financial information. Number 2 type of standard is International Standards on Review Engagement, that is ISREs, and it should be applied in the review of historical financial information. The 3rd type of standard is International Standard on Assurance Engagement, that is ISAEs. This should be applied in assurance engagements other than audit or review of historical financial information. The 4th type of standard is International Standards on Related Services, ISRS. This should be applied on compilation engagements. Engagement to apply agreed upon procedure to information and other related services engagement. The 5th type of standard is International Standard on Quality Control, ISQCs, and this should be applied for all the above services. In addition to this preface, certain ISREs, ISAEs, ISRE, RSCs, and ISQC1 are examinable in this paper. They are covered in later chapters. I repeat, in addition to this preface, certain ISREs, certain ISREs, ISAEs, ISRS, and ISQC are examinable in this paper. They are covered in later chapters. As discussed above, the IAASB's pronouncements do not override local law or regulations. If local laws or regulations differ from or conflict with the IAASB's standards, then a professional accountant, I repeat, if local laws or regulations differ from or conflict with the IAASB's standards, then a professional accountant should not state that he has complied with the IAASB's standards unless he has fully complied with all of those relevant to the engagement. International Standards on Auditing, ISAs. International Standards on Auditing, ISAs. ISAs are written in the context of an audit of financial statements by an independent auditor. They are to be adapted as necessary when applied to audit of other historical financial statements. Each ISA contains 1. An introduction, 2. Objectives, 3. Definition if necessary, 4. Requirements which are shown by the word shall and that will be applied as relevant to the audit. 5. Application and other explanatory material, which is for guidance only. This structure arose out of the work carried out as part of the IAASB's Clarity Project, see below. International Standards on Quality Control, ISQCs. ISQCs apply to all services carried out under the IAASB's engagement standards, which are ISAs, ISREs, ISAEs, and ISRS. Other international standards. The other international standards, ISREs, ISAEs, and ISRSs, follow the format of the original ISAs. They contain 1. Basic principles and essential procedures, identified in bold type and by the word should, and 2. Related guidance in the form of explanatory and other material including appendices. The basic principles and procedures must be followed. In exceptional circumstances, a professional accountant may judge it necessary not to follow a relevant essential procedure in order to achieve their objectives. In this circumstance, the auditor must be prepared to justify the departure from the requirements of the standard. Professional judgment. The nature of the international standards require the professional accountant to exercise professional judgment in applying them. The IAASB's Clarity Project. The IAASB Clarity Project Update. In October 2008, the IAASB issued a final Clarity Project Update, slightly ahead of the December 2008 date, by which the last of the clarified ISAs were to be approved by the Public Interest Oversight Board. The clarified ISAs came into effect for audit of financial statements beginning on or after 15 December 2009. Key points from this update, which gave some background to the project, are as follows. 1. The Clarity project was the IAASB's 18-month program to comprehensively review all of its ISAs and ISQCs to improve their clarity and therefore the consistency of their application. 2. 36 clarified ISAs were issued along with a clarified ISQC1. 3. 16 of the ISAs were substantially revised as well as redrafted, and one new ISA, which is ISA 265, was issued. The other 19 ISAs were redrafted but not revised. All the clarified ISAs contain improvements, including 1. Identifying the overall objective of the auditor when conducting an audit in accordance with ISAs. 2. Setting an objective in each ISA. 3. Establishing an obligation on the auditor in relation to those objectives. 4. Clarifying the obligations imposed on auditor by the requirement of the ISAs and the language used, using shall instead of should. 5. Eliminating ambiguity about the requirements which an auditor needs to fulfill. Then 5. Under IAASB Clarity Project Update. The ISAs have a new structure with introductory material, objectives, definitions, requirements, and application, and other explanatory material presented in separate sections in the ISA. Summary of the main changes in the new ISAs. The summary covers only those ISAs which were redrafted and revised, not those that were redrafted only. The summary does not claim to be a comprehensive analysis of all the changes, but lists those changes that are expected to impact on required audit procedures. ISA 200, overall objectives of the independent auditor and the conduct of an audit in accordance with international standards on auditing. ISA 200 has been revised to 1. Set out the overall objective of the independent auditor. 2. Explain the nature and scope of an audit designed to enable the auditor to meet those objectives. 3. It also explains the scope, authority, and structure of the ISAs and include general responsibilities of the independent auditor applicable to all audits, including the obligation to comply with the ISAs. New requirements make it clear that the auditor uses the objective in other ISAs to, I repeat, new requirements make it clear that the auditor uses the objectives in other ISAs to 1. Decide whether any additional audit procedures are needed beyond those required by the ISAs, and evaluate whether sufficient appropriate evidence has been obtained. ISA 200 also includes material explaining important concepts related to an audit, such as management responsibilities, professional skepticism, professional judgment, and the inherent limitation of an audit. ISA 210, agreeing the terms of audit engagement. The auditor is now required to perform specific procedures to establish whether the preconditions for an audit are present. These include 1. Determining whether the financial reporting framework to be used is acceptable. 2. Obtaining management confirmation that it understands its responsibilities for preparing financial statements that are in accordance with the applicable financial reporting framework, including giving a true and fair view. 2. Implementing internal control that will enable the preparation of financial statements that are free from material misstatements. 3. Providing the auditor with access to all relevant and all additionally requested information and unrestricted access to employees. The revised ISA 580 written representation requires the auditor to obtain representations from management in respect of these responsibilities. See below. ISA 260 Communication with those charged with governance. The revisions to ISA 260 were intended to reflect significant development to regulatory and auditing standards in several jurisdictions and shifts in the expectation of those charged with governance and other stakeholders. Additional requirements include 1. Explaining why significant accounting practices which are acceptable under the applicable financial reporting framework are not the most appropriate in the circumstances. 2. Documenting matters communicated orally. 3. Communicating any significant difficulties encountered during the audit. 4. Communicating any significant matters arising from the audit that were discussed or subject to correspondence with management. ISA 265. Communicating deficiencies in internal control to those charged with governance and management. This is a new ISA which is intended to improve the auditor's communication of deficiencies in internal control identified by him. The term deficiency in internal control is defined Requirements include 1. Determining whether identified deficiencies constitute significant deficiencies. 2. Communicating in writing all significant deficiencies, including a description of the deficiency and its possible effects. ISA 320. Materiality in planning and performing of an audit. In revising ISA 320, the IAASB did the following. 1. Updated the definition of materiality to make it clearer that materiality depends on the size and nature of an item judged in the surrounding circumstances. 2. Introduced guidance on the use of benchmarks for the initial setting of materiality, but did not set rules. 3. Indicated that during the audit, the auditor should be alert for possible management bias, such that when evaluating whether the financial statements as a whole are free of material misstatements, the auditor is required to consider both uncorrected misstatements and qualitative aspects of the entity's accounting practice. The IAASB concluded that it would be better to address materiality and the evaluation of misstatements in separate ISAs, which led to the creation of ISA 450. New requirements include 1. Determining a lower amount called performance materiality for the purpose of assessing risk and deciding on appropriate audit procedures. 2. Revising materiality during the audit if the auditor becomes aware of information that would have caused him to initially have set a different threshold. 3. Specific documentation requirements for threshold determined and any changes made during the audit. I repeat, specific documentation requirements for threshold determined and any changes made during the audit. ISA 402. Audit considerations relating to an entity using a service organization. ISA 402 was revised to reflect 1. The increased use of service organizations. 2. The need to bring the ISA into line with the risk assessment ISAs. Requirements include 1. Specifying matters to be included in the auditor's understanding of how the entity uses the services of a service organization. Where the auditor has concluded that requirements include specifying matters to be included in the auditor understanding of how the entity uses the services of a where the auditor has concluded that controls at the service organization operate effectively, specifying procedures to be performed in testing the operating effectiveness of controls, including 1. Obtaining a Type 2 report, 2. Testing controls at the service organization, 3. Using another auditor to test controls at the service organization. Specifying procedures to be performed if the auditor plans to use a report from another auditor as audit evidence, including 1. Being satisfied with the other auditor's professional competence and independence and the standards followed. 2. Procedures to determine whether a Type 2 report provides sufficient evidence about the effectiveness of controls at the service organization. ISA 450. Evaluation of misstatements identified during an audit. As explained above, ISA 450 is a new ISA which arose from the revision of ISA 320 on audit materiality. There are a number of new requirements which include 1. Accumulating all identified misstatements other than those that are clearly trivial. 2. Prior to evaluating the effect of uncorrected misstatements, reassessing materiality. 3. Determining whether uncorrected misstatements are material, considering their nature as well as their size. 4. Documenting the amount below which misstatements would be regarded as trivial. Documenting all misstatements accumulated during the audit and whether they have been corrected. Documenting the auditor's conclusion as to whether uncorrected misstatements are material individually or in aggregate and the basis for that conclusion. ISA 505. External confirmations. The revision of ISA 505 was in response to concerns that requirements in this area needed to be more rigorous. Compared to the previous version of ISA 505, there are more detailed requirements in relation to 1. Maintaining control over the confirmation request. 2. Obtaining further evidence to resolve doubts over the reliability of responses. 3. Conditions which must be present if negative confirmations are to be used. ISA 540. Auditing accounting estimates, including fair value accounting estimates and related disclosures. ISA 540 was revised in order to improve the rigor of the auditing of accounting estimates, particularly in view of the potential for management bias or earnings management by manipulating in this area. 1. The revised ISA. 2. Introduces requirements for greater rigor and skepticism in this area. 3. Provide standards and guidance on what constitutes a misstatement and on indicators of management bias. 4. Focuses work on areas of estimation, uncertainty, and risk. 5. Aligns more closely with the audit risk model. New requirements include 1. Obtaining an understanding as to how management identify the need for accounting estimates and how they make those estimates. 2. Reviewing the outcome of accounting estimates made in prior periods. 3. Evaluating estimation uncertainty and whether high estimation uncertainty leads to significant risk. 4. For identified significant risks, evaluating how management has considered alternative assumptions or outcomes, obtaining sufficient, appropriate evidence about whether management decisions are in accordance with the applicable financial reporting framework, evaluating the adequacy of disclosure of the estimation uncertainty. 5. Reviewing management judgment and decision in order to identify possible management bias. ISA 550 Related Parties. ISA 550 was revised in response to 1. Recent major corporate scandals. An example is Enron and WorldCom in 2002, which often involved related parties. 2. A need to focus more on a risk-based approach in line with other ISAs. 3. The revised ISA 550, which also seeks to assist auditors with the difficult task of identifying related parties and undisclosed related party transactions. New requirements include 1. Considering the susceptibility of the financial statement to material misstatements due to fraud or error arising from the entity's related party relationships and transactions. 2. Obtaining an understanding of the control put in place to identify account for and disclose related party relationships and transactions, and to approve significant transactions outside the normal course of business. 3. Treating significant related party transactions as giving rise to significant risks. 4. Specifying procedures to be performed if the auditor identifies related party or significant related party transaction that management has not previously disclosed to the auditor. 5. Specifying procedures to be performed for significant related party transactions outside the normal course of business. 6. Obtaining sufficient appropriate evidence about a management assertion that a related party transaction was conducted on normal commercial terms. ISA 580 Written Representations. ISA 580 was revised to respond to concerns that auditors may be over-relying on written representations. The revised standard introduces a number of significant changes. The main one is that it is made clearer that although written representations provide necessary audit evidence, they do not on their own provide sufficient appropriate evidence about any of the matters included. 1. New requirements include obtaining written representation about management responsibility include responsibilities for preparing financial statements that are in accordance with the applicable financial reporting framework, including giving a true and fair view, providing the auditor with access to all relevant information as agreed in the terms of the engagement, recording all transactions and reflecting them in the financial statement. If management does not provide the above, disclaiming an opinion on the financial statement should be the auditor's opinion. ISA 600 Special Considerations. Auditing of group financial statements, including the work of component auditors. The revised ISA introduces a number of new requirements where other auditors audit group components, increasing the group auditors' involvement in the work of component auditors. New requirements include: 1. In deciding whether to accept or continue an appointment as group auditor, considering whether the group engagement team will be able to be involved in the work of component auditors to the extent necessary to obtain sufficient, appropriate audit evidence. 2. Obtaining an understanding of the group, its components and their environment, and assessing the risk of material misstatement of the group financial statement, which can be mitigated by strong group-wide controls. Obtaining an understanding of component auditors, including their professional competence and whether they will comply with ethical requirements which apply to the group audits. 4. Determining a materiality level for the group as a whole and for each component where component auditors will perform an audit or a review for the purpose of the group audit. 5. Responding to assessed risk, including 1. Requiring an audit of the financial information using component materiality of any component which is of individual financial significance. Requiring an audit of the financial information or an audit of specific areas or specified audit procedures for any component which is significant because it is likely to include group-level significant risks. Corporate governance. The section overview are: 1. The meaning and nature of corporate governance. 2. Directors and auditors' responsibility. 3. Code of Corporate Governance in Nigeria. 4. The Audit Committee. The meaning and nature of corporate governance. Corporate governance is the way in which companies are managed and controlled. In particular, it focuses on the role of directors and their responsibilities to shareholders and other stakeholders. As a form of business entity, an important feature of companies is the divorce of ownership from management. One group, the directors, manage the business and make the important strategic decisions. A different group, the shareholders, finance the company and own it. Directors are seen as agents of the shareholders, and as agents of the shareholders, they should take decisions that are in the best interest of their shareholders, and they should be accountable to the shareholders for the way in which they have used the company's resources. The need for regulation for good corporate governance. There is some regulation of corporate governance in company law. However, basic legal requirements have proved inadequate for protecting shareholders from losses in a number of corporate scandals caused by directors of the company. As a result, more specific regulations or guidelines have been introduced to improve corporate governance. Regulations and guidelines vary from country to country. In some countries, there are detailed rules. In others, there are none. You are not expected to have a detailed knowledge of the corporate governance rules for this exam. Directors and auditors' responsibilities. In all aspects of corporate reporting, there is a basic distinction between the role of the directors and the role of the auditors. The directors are responsible for: 1. Preparation of financial statements. 2. Internal controls. 3. Providing the auditors with the following: 1. Access to information relevant to the preparation of financial statements. 2. Additional information relevant to audit. 3. Unrestricted access to persons. 4. Written representation. The auditors are responsible for reviewing that information and, in some cases, reporting on the extent to which the directors have complied with their responsibilities. It is good practice in accordance with ISA 210, agreeing the terms of audit engagement, to clarify the relative responsibilities of the directors and auditors in corporate governance matters. Code of Corporate Governance in Nigeria. There are two codes that you need to be aware of for this exam. However, detailed knowledge is only examinable in the B6 Management, Governance and Ethics paper. 1. Code of Corporate Governance for Banks in Nigeria. In Nigeria post-consolidation. This code is issued by the Central Bank of Nigeria. Compliance with the provisions of the code by banks is mandatory in Nigeria. Code of Corporate Governance for Public Companies in Nigeria. This code is issued by the Nigerian Securities and Exchange Commission, which issued codes in both 2003 and 2011 and is applicable to 1. All public companies whose securities are listed on a recognized securities exchange in Nigeria. 2. All companies seeking to raise funds from the capital market through the issuance of securities or seeking listing by introduction. 3. All other public companies. Other companies are encouraged but not required to comply with the provision of the code. The Financial Reporting Council of Nigeria has set up a committee to harmonize the various codes that currently exist. The Audit Committee. Audit committees in Nigeria. In many countries, listed companies are required or expected to have an audit committee. In Nigeria, CAMA 1990 Section 359 requires every public company to establish an audit committee. The Audit Committee is a subcommittee of the Board of Directors and it reports to the main board. At least one board member of the committee should be financially literate and have knowledge of accounting or financial management. All members should have basic financial literacy and be able to read and understand financial statements. A key purpose of an audit committee is to establish a buffer between the auditors and the executive directors in order to minimize the risk that the auditors might come under undue pressure from the executive members of the board. For example, the auditor may be influenced by the threat that the company will take away their audit work or non-audit work, and so may be more inclined to agree with the opinions and arguments of the management. The audit committee should therefore help to ensure the independence of external auditors. The Companies and Allied Matters Act stipulates that the audit committee shall consist of an equal number of directors and representatives of the shareholders of the company, subject to a maximum number of 6 members, and shall examine the auditor's report and make recommendations thereon to the annual general meeting as it may think fit. The audit committee member presenting to the members shall not be entitled to remuneration and shall be subject to re-election annually. Any member may nominate a shareholder as a member of the audit committee by giving notice in writing of such nomination to the secretary of the company at least 21 days before the annual general meeting. Duties and responsibilities. Both the Code of Corporate Governance for Public Companies in Nigeria, issued by the SEC, and the Companies and Allied Matters Act provides guidance as to the duties and responsibilities of the Audit Committee. The Code of Corporate Governance for Public Companies in Nigeria requires the duties and responsibilities of the Audit Committee to be set out in written terms. The duties and responsibilities should be to 1. Assist in the oversight of the integrity of the company's financial statements, compliance with legal and other regulatory requirements, assessment of qualification and independence of external auditor, and performance of the company's internal audit function as well as that of external auditors. 2. Establish an internal audit function and ensure there are other means of obtaining sufficient assurance of regular review or appraisal of the system of internal control in the company. Ensure the development of a comprehensive internal control framework for the company. Obtain assurance and report annually in the financial report on the operating effectiveness of the company's internal control framework. 4. Oversee management process for the identification of significant fraud risk across the company and ensure that adequate prevention, detection, and reporting mechanisms are in place. 5. At least on an annual basis, obtain and review a report by the internal auditor describing the strength and quality of internal controls, including any issues or recommendations for improvement raised by the most recent internal control review of the company. Next, discuss the annual audit financial statement and half-yearly audited statement with management and external auditors. Next, discuss policies and strategies with respect to risk assessment and management. Next, meet separately and periodically with management, internal auditors, and external auditors. Next, review and ensure that adequate whistleblowing procedures are in place and that a summary of issues reported are highlighted to the chairman. Next, review with the external auditor any audit scope limitation or problems encountered and management responses to same. Next, review the independence of the external auditors and ensure that where non-audit services are provided by the external auditors, there is no conflict of interest. Next, preserve auditors' independence by setting clear hiring policies for employees or former employees of independent auditors. Next, consider any related party transactions that may arise within the company or group. Next, invoke its authority to investigate any matter within its term of reference, for which purpose the company must make available the resources to the internal auditors with which to carry out this function, including access to external advice where necessary, and report regularly to the board. The Companies and Allied Matters Act states that, subject to such other additional functions and powers that the company's article of association may stipulate, the objectives and functions of the audit committee shall be to ascertain whether the accounting and reporting policies of the company are in accordance with legal requirements and agreed ethical practices. Next, review the scope and planning of audit requirements. Next, review the findings on management matters in conjunction with the external auditor and departmental responses thereon. Next, keep under review the effectiveness of the company's system of accounting and internal control. Next, make recommendations to the board in regard to the appointment, removal, and remuneration of the external auditors of the company. And next, authorize the internal auditor to carry out investigation into any activity of the company which may be of interest or concern to the committee. Money laundering. Section overview. Definition of money laundering. regulation, obligations placed on professional firms, duty of confidentiality and money laundering. Definition of money laundering. Money laundering can be defined as a process by which criminals attempt to conceal the true origin and ownership of the proceeds from their criminal activities. I repeat, money laundering can be defined as the process by which criminals attempt to conceal the true origin and ownership of the proceeds from their criminal activities. Criminal activities include drug trafficking, terrorism, theft, tax evasion, and other types of fraud. Money laundering is a process by which money earned from criminal activities, that is dirty money, is transferred and transformed so that it appears to have come from a legitimate source, that is clean money. If it is undertaken successfully, money laundering allows criminals to maintain control over the proceeds of their criminal activity and to provide a legitimate cover for their sources of income. There are various criminal offenses connected with money laundering. Examples include 1. Processing in any way of dealing with or concealing the proceeds of any crime. Examples of the proceeds of crime might include the following: tax evasion, offenses that involve saved costs, as this could result from environmental offenses or failure to allow health and safety regulation. Retaining overpayments from customers, payments made overseas that are deemed to be bribes and would be illegal in Nigeria. Next, attempting conspiracy or incitement to commit the above offense. Next, aiding, abetting, counseling, or procuring the commission of such an offense. Next, an act which would constitute any of these offenses if done in Nigeria. Next, failure by a person in the regulated sector to inform the appropriate party of a knowledge or suspicion that another party is engaged in money laundering. Next, failure to make a disclosure which is likely to prejudice in investigation into money laundering, that is tipping off. The last two offenses are the ones that accountants may find themselves affected by, even inadvertently, as accountants operate in the regulated sector and are therefore required to report suspicion of money laundering. It is made more complicated by the fact that suspicion is not defined in the law. However, it appears to be somewhere between mere speculation and actual proof. There are various defenses to charges of money laundering. 1. A report had been made to the appropriate party. 2. There was an intention to make a report and a reasonable excuse that is likely to include fear of physical violence or other menaces for not having done so. 3. Acquiring or using property for adequate consideration in good faith. Regulation. Due to the work of intergovernmental bodies such as the Financial Action Task Force on Money Laundering, FATF, many countries now have legal provisions in practice designed to detect, report, and ultimately prevent money laundering activities. These provisions vary from country to country and include the U.S. Patriot Act 2001 in the USA and the Money Regulations 2007 in the UK. In Nigeria, the Money Laundering Prohibition Act 2011 implements the recommendations of FATF in relation to customer due diligence, record keeping, report of suspicious transaction, and compliance. Obligations placed on professional firms. Money laundering may be of particular relevance to accountants and in particular auditors. In cases where criminals establish companies and use transactions between their companies to launder their dirty money. Specific obligations for detecting and reporting suspicion of money laundering are placed in professional firms, for example, lawyers and accountants and financial institutions. These requirements include the following. 1. Putting into place systems, controls, and procedures to ensure that the firm is not used for money laundering purposes. 2. Appointing a money laundering reporting officer, MLRO, whose responsibility is to receive reports on suspected money laundering activities from other employees and report them to the appropriate authorities. 3. Establishing and enhancing the reports keeping system. 1. For all transactions which must be kept for at least 5 years, with controls to ensure that they are not inadvertently destroyed. And 2. For verifying the identity of clients by obtaining financial documents such as for an individual passport or driving license supported by recent utility bills, and for a company certificate of incorporation. Next, establishing procedures within the firm for reporting any suspicion of money laundering by client companies. Next, training and educating staff in procedures for detecting and reporting suspicions of money laundering activities. These obligations are wide-ranging, and auditors and other professionals need to be fully aware of the extent of their responsibilities in taking care of them. Example: an international case involved a solicitor who was imprisoned for 6 months for failing to report his suspicion in relation to money paid to his firm by a client who was later convicted of drug trafficking. The solicitor misunderstood his obligation to report the suspicion, thus unintentionally committing an offense. Guidance from professional bodies. To ensure that professionals are aware of their responsibilities, ICAN's monitoring unit, as part of its monitoring process, checks to see if professionals have understood their obligations by asking a series of questions during their visit. In addition to any disciplinary action that may be taken by ICAN for breaches of the regulations, penalties for non-compliance with money laundering obligations can make a firm liable under criminal law to unlimited fines and make its principals, usually its partners, liable to possible imprisonment. In response to the increased expectation of legislators and regulators in many countries with respect to the accounting profession roles in detecting money laundering, IFAC has published a second paper on this topic. This paper highlights 1. The causes and possible means of preventing money laundering. 2. The signs of money laundering activity. 3. The vulnerability of banks, non-bank financial institutions, and other entities to money laundering. 4. Governance-related issues. The relative responsibility of directors and auditors for monitoring and reporting suspicion of money laundering. Duty of confidentiality and money laundering. The accountant's normal professional duty of confidentiality to clients is not an adequate defense where money laundering is concerned. In the case of reporting suspicion of money laundering, Practitioners in most countries are afforded statutory protection against claims for breach of confidence where reports are made in good faith and to the appropriate authority. This will be so even in cases where the suspicions later prove to be unfounded and wrong. An accountant may in fact find it hard not to commit the offense of tipping off, bearing in mind all the reporting requirements that an auditor has to fulfill. For example, bear in mind that if an auditor had a strong suspicion of knowledge of money laundering, he might want to resign his position. However, doing so would mean that he was required to report to the shareholders on his reasons in a statement of circumstances and also report any professional matters arising to his successor in a professional clearance letter. In such a circumstance, the auditor might be better placed not to resign at that time and should certainly take legal advice before doing so. Remember that taking advice from a solicitor will not constitute tipping off because it is protected by legal privilege. Accountants may find themselves in a position where they are prevented from making a report of a suspicion of money laundering because they have received information under a legal privilege. This will be rare. Consideration of law and regulation in an audit of financial statements. Considerations of law and regulations in an audit of financial statements. ISA 250. Section Overview. The legal environment and non-compliance by a client company. 2. Action by the auditor in the event of non-compliance or suspected non-compliance by a client company. The legal environment and non-compliance by a client company. ISA 250. Consideration of laws and regulations in an audit of financial statements requires the auditor to 1. Obtain a general understanding of the applicable legal and regulatory framework and how the entity is complying with that framework. This is part of obtaining an understanding of the entity and its environment. Here, the legal environment as required by ISA 315. 2. Obtain sufficient appropriate audit evidence in respect of compliance with those laws and regulations which might be expected to have a direct effect on material amounts and disclosure in financial statements. Next, perform the following audit procedures to help identify such instances of non-compliance. Make inquiries of management as to whether or not the entity is complying with the relevant laws and regulations. Inspect any correspondence with the relevant authority. Next, during the audit, remain alert to the possibility that other audit procedures might bring instance of non-compliance to the auditor's attention. Next, obtain written representation from management that all known instances of non-compliance or suspected non-compliance have been disclosed to the auditor. Lastly, document all identified or suspected instances of non-compliance and results of discussions with management and or other parties. Action by the auditor in the event of non-compliance or suspected non-compliance by a client company. If the auditor identifies or suspects material areas of non-compliance by the company, the following procedures are required. 1. Obtain an understanding of the nature of the act and the circumstances under which it has occurred. Next, evaluate the possible effect of the non-compliance on the financial statement. Next, for suspected non-compliance, discuss the matter with management. If compliance is not demonstrated, take legal advice. Next, if there is insufficient evidence of a suspected non-compliance, consider the impact on the audit report. This would constitute a limitation on scope, which is considered in a later chapter. Next, consider whether or not the non-compliance impacts on other areas of the audit. For example, on the overall risk assessment. Finally, consider how to report the non-compliance to those charged with governance and/or to shareholders and/or the authority. Chapter review. Before moving on to the next chapter, check that you now know how to 1. Explain the need for regulation of audit and assurance services. 2. Describe the role and structure of professional standards, including the standard setting processes. 3. Summarize the key features of corporate governance in relation to audit. 4. Explain what money laundering is and summarize the obligations and duties this places on the auditor. 5. Apply ISA 250 to the audit of financial statements. Quick quiz questions. Which one of the following statements is incorrect? A. If an ISA conflicts with national auditing regulations, auditors should follow the national regulations. ISA apply to engagements dealing with matters other than historical financial information. C. The guidance given in ISAs may be used in providing non-audit assurance services. D. ISQCs apply to audit but not to other types of assurance engagement. The answer is D. Standards on quality control apply to all services provided under IAASB's engagement standards. Question 2. Which of the following may be an effective defense for an accountant accused of money laundering? 1. An accountant owes a duty of confidentiality to his client. The accountant has reported the issue to the appropriate police authority. The accountant had reasonable grounds for fearing that his life was in danger. 4. The accountant acted in good faith at all times. A. 1, 2, and 3 only. B. 1, 3, and 4 only. C. 2, 3, and 4 only. D. 1, 2, 3, and 4. The answer is C. Money laundering regulations override the accountant's duty of confidentiality so that any suspicion of money laundering must be reported to the authority. Question 3. Which of the following should be responsibilities of the audit committee? 1. Reviewing the independence of the external auditor. 2. Making a recommendation on the reappointment of the auditor. 3. Reviewing the work of internal audit. 4. Report to shareholders on the accuracy of the financial statement. A. 1, 2, and 3 only. B. 1, 3, and 4 only. C. 2, 3, and 4 only. D. 1, 2, 3, and 4. The answer is A. The external auditor reports on whether the financial statements give a true and fair view, and the board as a whole states their responsibility for the financial statement. The audit committee is not responsible for the accuracy of the financial statement and does not include this matter in its annual report to shareholders. Number 4 question. If the head of the audit team discovers evidence of money laundering in a client's company, he or she should report the matter in the first instance. I repeat, if the head of the audit team discovers evidence of money laundering in a client company, he or she should report the matter in the first instance to A. the Criminal Investigation Authority for Money Laundering, B. the firm's Money Laundering Reporting Officer, C. the company's Board of Directors, D. the company's shareholders. The answer is B. Report to the Board of Directors of the client company would put the auditor at risk of tipping off the suspect, which is a criminal offense. In the first instance, the matter should be reported to the firm's MLRO. Question 5. Are the following statements true or false about auditors? About auditors' responsibilities with regards to money laundering in a client company. 1. If an audit firm reports reasonable suspicion of money laundering by a company's senior management to the Criminal Investigation Authority, but this suspicion proves to be unfounded, the audit firm may be liable in law to the client company. 2. If an auditor discovers evidence of money laundering in a client company, the audit firm must resign immediately from the audit. Statement 1A. Statement 1 is correct, but Statement 2 is incorrect. B. Statement 2 is correct, but Statement 1 is incorrect. C. Both statements are correct. D. Both statements are incorrect. The answer to number 5 is D. It would be a criminal offense for the audit firm not to report reasonable suspicion of money laundering to the auditors, to the authorities. I repeat, it would be a criminal offense for the audit firm not to report reasonable suspicion of money laundering to the authorities. The firm should not resign immediately from the audit if it discovers money laundering activity, because this would tip off the criminal suspect. That is the end of chapter 2. Thank you.